Michael McGlone is Senior Director on Commodities for Standard & Poor's. He joins us from his firm here in New York. Michael, welcome to Bloomberg News. Thanks for joining us today.
Thanks for having me.
Michael, with gold today, we see it little changed on this Tuesday. Are we expecting a rise on expectations right now that the dollar is going to continue to decline? And secondarily, would this also have something to do with the Federal Reserve keeping interest rates low for an extended period?
Well, and as an index provider, the day-to-day stuff is kind of just noise for us. But obviously, we focus on measuring the markets. But for gold, the key thing is longer term. Obviously, if the dollar continues to weaken, gold's an alternative asset. But the number one factor, I think, is short-term interest rates. The alternative, our opportunity cost of holding gold is the T-bill rate. And if you look at over the decade, gold increased from essentially around 300 to 1,100 or so, where it is now. And the two-year went from 6% to around 1%. So what's your opportunity cost of holding gold? It's about the lowest ever.
All right, so if you're looking at that T-bill, the opportunity cost offsetting the T-bill rate near zero, of course, so then it looks like a large part of your forecast or the best way to play gold is to watch the Federal Reserve and monetary policy.
Certainly, if the Federal Reserve was to be aggressive and start raising rates, short-term rates, the gold would probably suffer. And certainly commodities would probably suffer, but it depends on why they do that. Now, would they do that? Certainly they could, but it's unlikely, certainly at this stage.
So what's the best way to strategize for gold investments?
Strategize? Well, do you mean what's the best way to invest in gold investments?
Yeah, ETFs,
ETFs,
the hard asset.
ETFs are the easiest, as simple as there's ETFs that hold physical gold, there's ETFs that hold futures. Our indices track the futures, and they're very similar. Now, gold is one of the most easily stored commodity there is, so it's probably one of the simplest storage of value. It's the simplest storage of value commodity.
So, Michael, at least I realize it's a little bit early in the year to be looking forward, but are we expecting, at least for the foreseeable future, that gold is going to continue to watch the dollar?
Oh, certainly. There's going to be a relationship there, but I think what people have to be careful about is gold is up significantly over the decade as interest rates have declined significantly over the decade. Obviously, there's a lot of interest now. The interest really should have been 10 years ago. Now, yes, it's attractive, but if the Fed maintains a very easy policy, gold should continue to be attractive. One way to look at gold, I think, is also compared to the S&P 500.
Right.
The ratio currently is gold divided by S&P 500 is about 1. At the end of 2008, it was 1. And so that ratio is still about 1, although the correlation between gold and S&P 500 is quite low.
Michael McGlone of Standard & Poor's is talking gold with us today. Michael, thanks. We appreciate your input.